Today we're going to continue studying inventory, and then we will continue to, if we have time, I think we'll have time, continue to Chapter 8 on PPE. Inventory is on every exam, and you are asked often to find the cost of goods sold with inventory. You're often asked to find the cost of inventory using FIFO or average cost. So we need to make sure that you can calculate the cost using FIFO or average cost. We need to make sure that you know how to find cost of goods sold. And then lastly, we need to make sure that you know how to calculate the inventory write-down. So on your exam, you will likely have FIFO, inventory FIFO, inventory average cost, inventory cost of goods sold, and inventory write-down. So this is what you will have on your exam regarding inventory. So there will be 2 or 3 questions on your exam about inventory, but they tend to be not so hard. I think you can manage it. Not hard, but not easy. So last week we looked at the definition of what is inventory. The definition of inventory is usually not tested. It's usually not on the exam. So for your exam, you don't need to know the definition of inventory. But for us, it's good for us to know the definition of inventory. So first of all, inventory are the assets that you are selling, that you normally sell. Inventory are also the assets you use in the process of production. And there are also the materials or supplies to be consumed. So number 2 and number 3 would include raw materials that we use in making the inventory. So we have the inventory of finished goods, goods that are made already. We can have inventory of goods that we are in the process of making, work in progress. And we can have the inventory of raw materials that we use to make the inventory. And then we can have some consumable inventory that we will use up. And there will be nothing left. We use up in giving the service, or we use up in our production. So how about Barai Peng Hood? What is Barai Peng Hood's inventory? Buildings and houses. Okay. So their inventory are the houses that they're selling. That is their inventory. If the house is finished, then the inventory is the finished goods. But Barai Peng Hood or another condo or apartment building, they may be under construction, not finished with construction. Is the building under construction? Is that inventory too? Yes, it's also inventory. So we have the finished goods inventory. We also have the work in progress inventory. How about maybe Barai Peng Hood, when they're doing the construction, they have inventory of steel, cement, bricks. Are the steel, cement, bricks, is that also inventory?
Yes.
Yes. Inventory of raw materials. And the steel and the cement, the bricks, the tiles, they will become part of the house. Now, Barai Peng Hood or some other developer, real estate developer that has an inventory of houses, maybe during construction they use machines. They use machines to do some of the construction, and they might have an inventory of oil. They might have oil for the machines. Is the oil and gas or diesel of the machines, is it going to become part of the house? No, it's not going to become part of the inventory. It's not going to become part of the inventory of finished goods. It's not going to become part of the house. But it is still inventory. It is the inventory that they will consume in production. They will use up in production. So we also include in inventory the inventory such as the diesel or the oil that we will use up during production. Many companies show cost of goods sold. And when you show cost of goods sold expense, this is one formula to calculate cost of goods sold. So opening inventory. What does opening inventory mean? It's the beginning brought forward. Yes, the brought forward inventory. And brought forward inventory, opening inventory is the beginning inventory. So beginning of the year, beginning of the period. And then plus purchases. So the new materials we buy. And then minus closing inventory. Closing inventory, we learned the word carry down. Inventory carry down. Closing inventory carry down is the ending inventory. How much inventory you have at the end of the year. So beginning inventory plus purchases minus the ending inventory gives us cost of goods sold. So for your exam, you need to make sure you know this formula very well. I would like to look at this example just to show you the difference between periodic inventory and perpetual inventory. This is unlikely. This is unlikely to be on your exam. It could be on. There could be a question about it on your exam, but unlikely. So this example is more just for our understanding. It's not going to be on the exam. But it can help us understand what comes next. So, as it says in the slide here, there are two methods of recording inventory and cost of sales. Number one, the periodic system. Number two, the perpetual system. And for your exam, you will be tested mainly on the periodic system. So you're going to have a periodic inventory on your exam. Periodic inventory means that you calculate the cost of goods sold at the end of the period. The period is a month or a year. So in the periodic system of inventory, you find the cost of goods sold at the end of the month or the end of the year. The second way is a perpetual system. The perpetual system, you calculate the cost of sales every time you make a sale. You are updating. The word perpetual means continual. You are updating your cost of goods sold. You are updating your inventory continually. So here we have an example of, it says, for example, a business starts the year with 6 units of inventory, which it bought for $100 each. During the year, the business has the following purchases and sales. Okay, so 6 units times $100 each. So we have the opening inventory of 600. During the year, the business has the following purchases and sales. Purchases, January 1st, they purchased 10 units at $100 each. So 10 times 100. Then March 1st, purchased 8 units at $100 each. So 8 times $100. Yeah. So we have two purchases. And then sales, February 1st, they sell 3 units, and then May 1st, they sell 4 units. And then in the end of the year, an inventory count shows there are 17 units remaining. Okay, and so they sold a total of 7. So we started with 6 plus 10 plus 8, so 24 minus the 7, and we get the 17 that are remaining in the end of the year. So the first example here is the periodic inventory. And this is the inventory this is the method on your exam. So your exam is using this method. What are we going to have first? We're going to have first the brought forward amount here. So first we have the brought forward inventory of 600. The brought forward inventory is the opening inventory. It's the beginning inventory. And then we buy. How many times did we buy? Well, this example says that we bought on January 1st and then March 1st. And when we buy, in the periodic method, when we buy the inventory, we debit purchases. Debit purchases and credit payables. Unless you pay cash. If you pay cash, credit cash. So we debit purchases. So you see here, we don't debit inventory. We don't debit inventory. We debit purchases. And the closing inventory, the ending inventory, it says here, closing inventory, 7. I think that's a mistake. Should be 17. Closing inventory, 17 times 100 is 1,700. That's the closing inventory. So what we're going to do is, first of all, we're going to record the closing inventory. And we debit inventory 1,600. And the opening inventory is transferred to cost of goods sold. And cost of goods sold is an expense. So we're assuming that the inventory from the beginning of the year, we sold it. It's all gone. And then the purchases here is also transferred to cost of goods sold. And notice now the purchases account, the debit balance is 1,800 and the credit side of the account is 1,800. So now the purchases is 0. We have closed the purchases account. So the purchases account becomes 0 at the end of the year or the end of the period. So the beginning inventory transfers to cost of goods sold. Purchases transfers to cost of goods sold. And remember the formula? Cost of goods sold is opening inventory plus purchases minus closing. So cost of goods sold is an expense. Expense is a debit. So we plus purchases plus opening inventory and then minus the closing inventory. So the closing inventory, debit inventory, and credit cost of goods sold. So the closing inventory makes cost of goods sold go down. So this is the periodic method. This is the method on our exam. The other method that is not on your exam is the perpetual system. The perpetual system records the expense records inventory and expense every time you buy and sell. So you can see there is no purchases account. Every time you buy the inventory, debit inventory, debit inventory, debit inventory. Every time you sell, credit inventory, and debit cost of goods sold. Credit inventory, debit cost of goods sold. So in the perpetual method, you record the cost of goods sold every time you sell. So perpetual means continual. So you are continually recording cost of goods sold every time you sell. Should you follow the perpetual method or should you follow the periodic method? You can follow either, it's up to you. Periodic method here, this is used more with smaller companies. And one reason this can be good for smaller companies is you do not need to calculate your inventory until the end of the period. Because in the perpetual method, you have to count your inventory and count what inventory you sold every time you sell. So that takes a lot of work. It's difficult to do. How can the big company do this? How can a big company do this? For the big company to do this, they need to have a good system to scan the inventory in and scan the inventory out. So they are updated on what they've sold all the time. So for our exam, we're going to use the periodic system with the purchases account. On your exam, you need to be able to calculate the cost of inventory using FIFO or average cost. You should also know what is the cost of inventory. The cost of inventory, it's really simple. The cost of inventory is all the cost that you need to make the inventory. That's the cost of inventory. All the cost to make the inventory. Let's say that we have a factory in Chengchao for making shoes. So we have a factory for making shoes. Should we include in the cost of inventory the cost of the gaosu that we use for the shoe? Yes, we will include the materials. How about the cloth or maybe the leather? Should we include the leather of the shoes? Yes. How about glue? Because maybe we need some glue in the shoe. Should we add the glue to the inventory? So the cost of the inventory is all the materials, right? How about the salaries of the workers?
No.
Should we add to the cost of the shoes?
No.
Now some of you say no, some of you say yes. The question is, do you need the worker to make the shoes?
Yes.
If the answer is yes, then the salary of the worker you add to the shoes. So the answer is yes, we add the cost of the worker to the shoes because we need the worker to make the shoe. How about the salary of the supervisor of the workers? Now we think, well, the supervisor is not really making the shoe, right?
Yes.
But are the workers going to make the shoes if you don't have the supervisor? No, so the supervisor of the worker, you also add to the cost of the shoe. Even the factory manager, you will add to the cost of the shoe. How about, let's say we rent the factory. Should we add the rental cost of the factory to the cost of inventory? Do you need the factory to make the shoes? Yeah, so even the rent of the factory we add to the cost of inventory. We can't make the shoe out in the field, right? We need the factory. How about electricity in the factory? Should we add to the inventory? Do we need electricity to make the shoes? Yes, so also we add electricity. How about depreciation of the machine? Do you need the machine to make the shoe? So also depreciation of the machine, we add to the cost of inventory. So for the factory, almost everything is added to the inventory for a factory. So most things, when you're producing in production, most of your costs you add to the cost of the inventory. When you are in production. What would you leave out? What would you leave out? Well, you'll leave out what it says here. You'll leave out any abnormal waste. Abnormal waste mainly is wasted time. So in case your workers and your factory is not being productive, if you have a week or 2 weeks where you're not really producing to full capacity. So any wasted time and any wasted materials. So wasted time and wasted materials are just recorded as an expense. We should also not add storage cost. So storage, they mean the storage of the finished product. And they say except maturing inventory. What they mean is if you need the storage for production, then the storage is added to inventory. For example, wine. We need to store the wine to make the wine. So the storage of wine is part of the production of wine. So you need to store wine for like 2, 3, 4 years. So if the storage is part of production, then you add the cost of storage to your inventory. Also whiskey has to be stored. Cheese. And how about brahar? How long do you need to store the fish to make brahar? Maybe 6 months. So for brahar, also the cost of storing for 6 months, you would add to the cost of the inventory. Anyway, I'm sure there are some people in Cambodia that are very rich from making brahar. Now, when you make or you buy inventory, we have 3 ways to record the cost. And the first two will be on your exam. The third one will not be on your exam, but the first 2 will. The first is first in, first out. And it means that the first one you sell is the first one that you buy, which is normal. So when you're selling vegetables, if you were selling vegetables in a grocery store, the first vegetables you buy, you try to sell first. Otherwise, they will be old and go bad. So for most businesses, the first one you buy, also you try to sell first. So first in, first out matches your business. It matches what you do. For average cost might be appropriate for companies that sell oil, sell gas, where the inventory is all mixed together. That would be appropriate. But you can use either method. So you are free. Even you're selling vegetables, you can use the average cost. So you are free to choose which method you think is appropriate. FIFO or average cost. Or in the case, let's say you have an inventory of land. Every land has a different price. Every piece of land has a different value. So for assets, for inventory where each inventory has a different value, you can use the specific individual cost. We cannot use LIFO. And it's only mentioned because LIFO is allowed in the U.S., in U.S. accounting. They allow LIFO. So if you work with a U.S. factory company, they may want to use LIFO, but we have to tell them no. In Cambodia, we can't use LIFO because we follow IFRS. And anyway, LIFO doesn't match what we normally do. When we're selling, we don't sell the last one we buy. When we sell normally, we sell the first one we buy. So we can't use LIFO. So here's an example. We're going to use this example to look at FIFO and average cost. For average cost, there are two kinds of average cost. There is the periodic average cost, which is easy. And then there is the perpetual average cost, which is more complicated. So hopefully, on our exam, we have the easy average cost. But we should know both, just in case we have the perpetual average cost. Okay, so what we're going to look at right now, will be on your exam. I promise you, this is going to be on your exam. So make sure that you know this. And you know it's on your exam, so now, in the next few minutes, you're going to guarantee that you're going to get at least 2 marks on your exam. Could be up to 4. So this example says, on 1 January 2007, a company held 200 units of finished goods valued at $10 each. During January, so this is the opening inventory, 200 at $10 each. So opening inventory, 200 times $10, 2,000. On January 1st, 10, we purchased 300 at $10.85 for a cost of $3,255. And then on 20 January, we bought 350, and we bought at 1150, so that's 4,025. And during the month, on 14 January, we sold 280, and then on 21 January, we sold 400. Okay, so let's look at the 3 methods to find the cost of goods sold. So we have 3 methods on the exam. Number 1, FIFO. Number 2, the periodic average cost. Number 3, the continuous average cost, or we can say perpetual average cost. So we have the 3 methods. So for your exam, absolutely you need to know FIFO. So FIFO is guaranteed on your exam. Average cost. If you have average cost, probably you're going to have the periodic average cost. For continuous average cost, maybe on the exam, maybe not. So we're not sure it's going to be on the exam. So how many kinds of inventory do we have? Well, number 1, in the beginning we got the $10 inventory. And then we bought the $10.85 inventory, and then we bought the $11.50 inventory. So we bought 3. We bought 3 kinds of inventory. One way to answer the question or understand the question is to list. To list your inventory, to list them in columns, so that on the left is your first inventory, and then show your second inventory, and then show your third inventory. On your exam, usually you'll have 3 inventory, just like this. 3. They're not going to give you 5 or 6 inventories. They will make it simple. So you'll have 3, at the most 4. Typically 3. Okay, so why did we put the $10 inventory on the left? Because this is the original, yes. It's the first inventory we bought, and then the second, and then the third inventory. We want to know how many units. So for the $10 inventory, we bought 200 units. For the $10.85, we bought 300 units, then 350. We sold 2 times. We sold on the 14th January, and then we sold on 21 January. And if we go back to the question, it says that on 14 January we sold 280. So first in, first out means we should sell the $10 inventory first. So $10 inventory is the first inventory. It's the first one in, it's the first one out. So we sold 280. So first we sell all of the 200. And then second, we sell the second inventory, of which we sell 80. So we sell the first inventory first and the second inventory second. And then on the next day, we sell 400. So we sell the second inventory second, and then we sell the third inventory last. And so we see what's remaining. The first inventory is, we have 0 units. And so this is all units, right? It's not $200, it's 200 units. So this is all units. So we're left with 0 units, and the last inventory we have 170 units left. Now we can find the closing inventory. So the closing inventory is 170 units times the cost of those units, $11.50. And this gives us the ending inventory of 1955. So this is the closing inventory. Now we can do the cost of goods sold. So opening inventory, 2,000, plus the total purchases, minus the closing inventory, that equals the cost of goods sold. What is your exam going to ask you? Your exam will probably ask you, they'll ask you 2 questions. They'll ask you, what is the value of ending inventory? Or they will ask you, what is the cost of goods sold? So they will ask you one of those questions. So this is FIFO. If we go back to the example here, so we have purchases of 3,255, we have purchases of 4,025, and then plus 2,000, which is the opening inventory. So the total cost here is 9,280. It's the we can call this the total cost. For the average inventory, we take the total cost divided by the total units, and that gives us the average cost. And then again, we take the total cost minus the closing inventory, and that gives us the cost of goods sold. And the closing inventory, so we have the total units minus the ending units times the average cost. So this gives us this is the average cost method. The cost of goods sold is 7,424 And in the last example, with FIFO, the cost of goods sold is 7,325. Why is the cost of goods sold more? For average cost, the cost of goods sold will be higher when prices are going up. If prices are going down, the cost of goods sold will be lower. But if prices are going up, average cost of goods sold will be higher. The opposite for the closing inventory. The opposite for the closing inventory. When prices are going up, the FIFO closing inventory is higher, and the average cost inventory is lower. So this is the periodic average cost. What seems easier to you, FIFO or average cost? So on your exam, the average cost is going to be easier on your exam. The next example here is continuous average cost. This is a bit complicated. Continuous average cost, it's the same as average cost, except that we need to calculate the average cost every time we sell. So we have an average cost with every sale. So in our example, we have two sales. We have a sale on January 14, and then we have a sale, again, January 21. So we have two sales. So with continuous average cost, you need to find the average cost for every time you sell. And we have the opening 200 units times the cost of $10. So that's 2,000. We have one purchase of 300 times 1085, that is 3,255. And then 3,255 divided by 500 gives us the average of 1051. So 1051 is the average. And then we sell 280. 280 times 1051 is equal to 2943. So in the continuous average cost, we calculate the average cost every time we sell. Okay. We had 500 minus 280, and then we are left with 220. We purchased 350. 350 times 1150 is equal to 4,025. And 4,025 plus 2312 is 6,337. Oh, I'm sorry, earlier I made a mistake here. It should be 525. And 6,337 divided by 570 equals 1120. So we find the average again. And then again we sell 400 times 11.12 equals 444. So we find the average cost every time we sell. The average cost is the total cost divided by how many units you have. There is often on your exam a question about this table. And you remember I said that when prices are going up, the cost of goods sold for average cost is going to be higher. When prices go down, the cost of goods sold for average cost is going to be lower. And the opposite with FIFO, yes. If you can't remember that or you don't understand that, well, here is the table for you. So you can memorize this table. So when prices are going up, the FIFO closing inventory is going to be higher. It's because with FIFO, if prices are going up, the beginning inventory is cheap, the ending inventory is expensive. So in FIFO, you sell the cheap inventory first, you are left with the expensive inventory. So the FIFO inventory will be higher, the closing inventory will be higher. And for the average cost, the closing inventory is going to be lower. And when prices go up, FIFO, the closing inventory is higher, so the cost of goods sold is going to be lower. And average cost higher. And then the profit, if the cost of goods sold is lower, the FIFO profit is going to be higher. And then the average cost profit is going to be lower. If you can't remember all of these, that's okay. Just remember prices rising, and you know that prices going down will be the opposite. And even then, you know average cost is always the opposite of FIFO, so as long as you can remember FIFO for prices rising, then you'll be okay. So remember, when prices rise during the year, the FIFO closing inventory is going to be higher. The FIFO cost of goods sold is going to be lower. The FIFO profit is going to be higher. And then average cost is the opposite, and when prices, yes?
When you talk about higher or lower, what do you think?
Higher means more, higher value.
What are you comparing to? Higher than the original cost?
Higher than compared to average cost. So we're comparing FIFO and average cost. So the FIFO closing inventory is higher than the average cost closing inventory. The FIFO cost of goods sold is going to be lower than the average cost of goods sold. So this is comparing average cost and FIFO. So this is a popular exam question. So let's do an activity. On 1 November 2016, the company had 300 units of finished goods, item number 9639 in inventory. These were valued at $12 each. During November 2016, 2 batches of finished goods were received into store from the production department as follows. So 10 November, we had 400 units at $12.50. And 20 November, 400 units at $14. Goods were sold out of inventory during November as follows. We sold 500 units on 14 November, and then we sold 500 units on 21 November. So let's find the cost of goods sold using FIFO. Let's find the cost of goods sold using the periodic average cost. So I'll get you started on the FIFO and average cost. So we have 3 inventory. We have the $12 inventory, we have the $12.50 inventory, we have the $14 inventory. So we can put these in columns. $12 inventory, $12.50 inventory, and $14 inventory. Next, we want to know the units. So the $12 inventory, we opened with 300 units. $12.50, we opened with 400 units, or we bought 400 units, and the $14 inventory we purchased another 400. And we had 2 sales. One sale was on 14 November. The other sale was on 21 November. The opening inventory is 12 times 300, 3,600. So we want to add our purchases, and we want to minus the ending inventory, so that we can get the cost of goods sold. I'm going to give you 10 minutes to find the answer to this, and also to find the answer to the average cost. And then the continuous average cost, we'll go ahead and do together. So why don't you do FIFO and do the periodic average cost? So let's have you do the periodic average cost. And then we can do together the continuous average cost. Okay, so first we sell 500, so we'll sell 300 of the $12 inventory, and then we sell 200 of the $12.50 inventory. So now the $12 inventory is gone. And then the next day we sell, on 21 November, we sell 500 again. So first we sell 200 of the $12.50 inventory, so that's gone. And then we sell 300 of the $14 inventory, so we are left with 100. So our opening inventory is 3,600. Our purchases are 400 times $12.50. Which is 5,000 plus 400 times 1,400. 400 times 14 is 5,600. So the purchases are 10,600. The ending inventory, we have left, not $100, 100 units. We have 100 units at a value of $14 each, so that's 1,400. So the cost of goods sold is 3,600 plus 10,600 minus 1,400. And yes, 12,800. Your exam will ask you for ending inventory. Sometimes they ask you ending inventory. Sometimes they ask you cost of goods sold. So one of these numbers will be on your exam. For the periodic average cost, we need to find the total cost. The opening inventory was 3,600, and then we bought inventory of 5,000, 5,600. So the total cost is going to add up to 10,600, so 14,200. And this is the total cost. So we take the total cost divided by the total number of units, and the opening inventory, we can look here, so the units was 300 plus 400 plus 400, so we have 1,100 units. So total cost divided by total units gives us 12.90909090. You can just round to 12.91. So the ending inventory is 100. The average cost is 12.91. So total cost less the ending inventory gives us cost of goods sold. Of 12,910. So for,
Let's see,
yes,
909.
909. Okay, but I used 1291, right? Okay, 14. Minus 12. 12909. So what do you feel? What is faster and easier on your exam? FIFO or average cost? So for your exam, the average cost is easier. But when you are doing your business, what is easier? FIFO might be easier for your business because for FIFO, you only need to know the price of your ending inventory. You only need to know the price of your ending inventory for FIFO. But for average cost, you need to know the price of all the goods that you purchased during the year, and then divide by the total units to calculate the average cost. That might be challenging. But if you've recorded the number, then that's fine. So, although on your exam the average cost is easier, for your business, FIFO might be easier. Because in FIFO, you only need to know the price of your ending inventory. You just need to know the price of the last inventory that you bought. So now let's do the continuous average cost. Continuous. So we have the opening inventory of 3,600. This is 300 units times $12. And then we buy 400 units at $12.50. That's 5,000. So this is 8,600. 8,600 divided by 700. We have an average price of $12.29. $12.29, and then we sell 500 units times, we can use $12.29. So we sell 6,145, and we're left with $2,455. And 700 minus 500, we have 200 units. We have 200 units, and then we purchase 400 units at $14. $8,055 divided by 600. $13.43 average cost. And then we sell 500 again. We have closing inventory of 1,340, and the number of units that we're left with is 100 units. 100 units at 1,340. So the closing inventory is 1,340, whereas using FIFO, using periodic average cost, it was 12,909, and using FIFO, it was the ending inventory is 1,400. Sorry, and the ending inventory here is 1291 ending inventory. So we go from ending inventory 1,400 to ending inventory 1,340. So with average cost, when prices are going up, average cost gives you a smaller ending inventory. FIFO gives you a bigger ending inventory. So this is the continuous average cost, and for the continuous average cost, we need to find the average cost every time that we sell. So we sell 2 times, so we need to find the average cost 2 times. What do you do when you're doing your exam and you have average cost, but the question doesn't say periodic or continuous? Just assume periodic, just do periodic. So if the question doesn't say, just do the periodic average cost. Now, sometimes the value of your inventory can go down. So if you have, how about inventory of gold right now? What's happening to inventory of gold? Do you think the price is going up or down? Gold. So gold right now is going up because of the threat of economic recession. So right now in the world there's a threat of economic recession. So that can cause the price of the dollar to go down. The price of the dollar goes down. The price of gold is going to go up. Also, there's more demand for gold in a recession because people feel that it's a safe investment, where the value cannot go down that much. How about the price of oil right now? Going down. So the price of oil during the recession, people are doing less business. So recession is So during recession, people do less business. Less business, you have less demand for oil. So the price of oil should go down. So the cost of inventories can go down. If that happens, you may have what we call a write-down expense. A write-down expense. How about Huet, or maybe the company that's building the condominiums? They have the inventory of condominiums. Can they have an inventory write-down? Can the cost of the condominium inventory go down? You say no, right? Can the cost of the land inventory go down? You say no? But it can, right? Where in the world are prices of land and apartment going up a lot in the last 10 years? One place in the world that the price of land and apartments went up a lot in the last 10, 20 years is Hong Kong. Very high, extremely high. So very, very high, going up every year, 20%, 30%, 50%. But how about right now? Do you want to live in Hong Kong right now? No, right? So no one wants to live in Hong Kong right now. Maybe many people want to leave Hong Kong. So this is going to make less demand for apartments, less demand for land, less demand for apartments, less demand for land. You cannot sell your apartment at the price. You lower the price. Anyone want to buy your apartment? Still no. So this can cause the impairment in the price of the inventory of apartments and houses in Hong Kong. And then it can Chuang, go to Chumlu. So the price of land apartments goes down in Hong Kong, and then it goes down in Shanghai, Then it goes down in other parts of Asia, and then Cambodia. And then you have an inventory write-down. Anyway, hope it doesn't happen. But now we're going to look at the accounting of the inventory write-down. So the rule here is inventory must be valued at the lower of cost and net realizable value. Which one is smaller? If cost is smaller, keep it at cost. If net realizable value is smaller, then you have a write-down. Net realizable value is kind of a weird word. It's a strange phrase, but the meaning is how much money you can get from selling the asset. How much money you can get from selling it. So usually the net realizable value, it's just equal to the selling price. And the selling price of the inventory is usually higher than the cost. So in that case, there's no write-down, you just keep the cost. So inventory, you must show the smaller. Which one is smaller? If cost is smaller, show cost. If the selling price is smaller, show the selling price. I said selling price, right? But sometimes selling price is only for finished goods. Let's say Boriping Wood, they have some housing inventory where the house is halfway constructed. Can you sell the half constructed house?
Yes.
Well, yes, you can. But anyway, we're going to pretend you can't, or they don't want to. So we're going to take selling price minus cost to complete. So selling price minus the cost to finish the production of the inventory. And then, if you have a commission that you have to pay to your salespeople or to agents, we minus the sales cost. Sales cost means, or cost to sell means the commission you pay to salespeople or commission that you pay to an agent. And the same formula is shown here. So expected selling price means selling price. Cost to get the item ready for sale means cost to complete. And then selling cost is the sales cost. And this gives us the NRV. NRV is a net realizable value. There are two things tested on your exam. Number one, you may be tested to calculate NRV, so you need to remember the formula. Number two, on your exam, you may be tested on the write-down expense. But please keep in mind, you only have a write-down expense if the cost is more than the net realizable value. Then you have the write-down expense. If the net realizable value is bigger, no problem, no write-down. Okay, so for example, we have the answer. Chris is trying to value her inventory. She has the following information. The selling price is $35. The cost incurred to date is $20. Cost to complete is $12. Cost to sell is $1. What is the net realizable value? It's going to be the cost. So it's going to be, the selling price, 35 minus cost to complete 12 minus cost to sell 1. So 22. Yes. What is the cost incurred? Means the cost we spent so far. The cost we spent on to make the inventory so far. Like if you have an inventory of a house, it means how much did you spend so far to make this house? So here the net realizable value is 22. The cost is 20. So the cost is smaller. Do we have a write-down? No, no write-down. We only have a write-down if the net realizable value is smaller. But in this case, the net realizable value is bigger than cost, so there's no write-down. So let's look at these two examples before we take a break. I'll do this with you. An item of inventory is completed with the following cost. Materials, 200, labor, 150, storage, 50. What is the inventory cost? What should we record for inventory? There's a trick here. Do we need materials to make the inventory? Yes. Do we need labor to make the inventory? Yes. Do we need storage to make the inventory?
Yes.
No. We leave the storage out. So we assume, on our exam, we assume storage is for storing the finished goods. But if the storage was part of production, okay, add the storage. But if the storage is for finished goods, we leave it out. On your exam, you will leave out storage. So the cost is $350. It says the market value of materials used in the inventory now has a value of 25. So before it was 200, it went all the way down to 25. So maybe you bought spawn, and the cost of spawn was 200. And then there's the again. And then your spawn only has a value of 25. It went down a lot. So do we have a write-down?
Yes.
We don't know yet. The reason we don't know yet is that we don't have write-downs for the raw materials. We don't have write-downs for raw materials. Unless your business is to sell the raw materials. If your business is to sell the materials, then we can have a write-down. But if you are using the materials in production of another asset, there's no write-down for raw materials. So it looks like there would be a write-down, but actually, no. We do not calculate write-downs on raw materials. We only calculate write-downs on the final product. So we have to keep reading. It says that the selling price of the inventory is $500 with expected selling cost of $200 or $20. So the net realizable value is going to be the selling price minus, is there a cost to complete mentioned? Cost to complete is, cost to complete means any more cost to complete. The story does not mention any more cost to complete. $350 we spent already. Cost to complete means any more future cost to finish. So it doesn't say any more future cost to finish. So cost to complete is 0. And then minus the selling cost 20. So the inventory has a value of 480. So is there a write-down? So cost is 350. Net realizable value is 480. Net realizable value is bigger than the cost. So is there a write-down? No, no write-down. So we can include no write-down. No write-down. Okay, next, number 2. An item of inventory is being prepared for customers. So far the costs are materials. Should we include materials? Yes. Should we include the production overhead? Production overhead means like electricity, factory, rent. Should we add? Yes. And labor, should we add? Yeah, so we add them on. So the cost is 600. The company expects to spend another $200 to finish the item. The selling price is $700. There will be an $80 commission paid on sale. So selling price is 700 minus cost to complete 200 minus cost to sell 80. So 500, 420. And this is the net realizable value. So cost is 600, net realizable value is 420. Is there a write-down?
Yes.
Yes, there's a write-down. So the write-down is 600 minus 420 is 180. Write-down is an expense, so we're going to debit write-down expense. You can also debit cost of goods sold. You can debit some other expense as well. That's fine. So debit write-down expense 180, credit inventory 180. So credit inventory makes inventory go down. So inventory is an asset, credit makes the asset go down. When the value of your inventory goes down, it's a loss. So loss is an expense, and expense is a debit. So debit expense, credit inventory. Okay, let's take a break, and after the break, we're going to do some exam questions and practice. Okay, following here, we have some exam questions from the past exams. So your exam is 2 hours. So 2 hours times 60 minutes, 120 minutes. And so 120 minutes divided by 100 marks, 100 points. That's 1.2 minute per point or per mark. And each of these short questions, usually it's 2 marks. So 2 marks times 1.2 minute per mark. So you have 2.4 minutes to answer each question. So on your exam, you'll have 2.4 minutes to answer each question. Some questions you should try to do faster than 2.4 so that you can spend more time on some other questions. So some harder questions you might need 3 minutes, 5 minutes. Question 1, I think you guys can do. Question 2. And question 2, it says here, uses the continuous weighted average cost. And in this question it says, you can see that it says issue. Issue means sell. So the continuous weighted average cost, we need to calculate the average cost for each time we buy and sell. So opening is 30 times $2 each, that's 60, and then we buy 50 times 2.4 is 120. So that's 180. So 80 units. So 180 divided by 80. And then it says we issue 40. That means that we sell. We sell 40. And then we purchase 60. So we purchase 60 at 2.5. That's 150. And then in the very end it says that we sell 25. And we have to find the average again. Oops, it's going to be here. So 80 minus 40 is 40, plus 60 is 100. So question 2 is the continuous average cost. The word issue means sell. It says, what is the value of the balance? They want to know what is the ending inventory. Question 3 is about FIFO. It says the opening inventory is $3 each and 15 units. So $3 inventory, you have 15. And then it says you sell 5. And then you buy 10 of 3 at $3.50, so you buy 10. And then you sell 2 times. You sell on 3 July, and you sell again on 12 July. And it asks, what is the closing inventory? Question 4, in times of rising prices, the FIFO method of inventory valuation, when compared to the average cost method of inventory valuation, will usually produce. Okay. Question 5 is about a write-down. It says you sell basic, super, and luxury. The following information was available. So we have basic, super, luxury, original cost, estimated selling price, selling and distribution cost, and units. What is the value of inventory at year end? Remember, the value of inventory must be the lower of cost, and net realizable value. Which one is lower? So the cost we have, you have the cost here, but you do not have the net realizable value. So you need to find the net realizable value. So remember, net realizable value is equal to the selling price minus cost to complete. There is no cost of completeness. Minus selling price. So for example, for the basic here, the selling price is 9, selling cost is 1, so the net realizable value is 8. And what is smaller, cost or net realizable value? Cost is 6, net realizable value is 8. Which one is smaller? Cost is smaller. So we take 200 units times 6. So for this inventory, the value is 1,200. For question 6, the closing inventory of X amounted to 116,400. Excluding, not including. Exclude means leaving out. Number 1, 400 items which had cost $4 each. All were sold after the reporting period for $3 each, with selling expenses of $200 each. So for number 1, we want to find the cost and the net realizable value and see which one is smaller. So in this case, the cost is 400 times 4, 1,600. And they were all sold for $3 each. So the selling price, 400 times 3. Selling expense is 200 minus the selling cost. So 1,200 minus 200 is 1,000. So the cost is 1,600. The net realizable value is 1,000. So we should include the one that's smaller is 1,000. So we'll take 116,400 plus 1,000 because we take the smaller of cost. For number 2, it says we have 200 different items which had cost $30 each. These items were found to be defective at the end of the reporting period. Rectification work means fixing. So fly ripjamlargwen. After the statement of financial position amounted to 1,200. So 1,200 is the cost to complete. After which they were sold for $35 each. $35 is the selling price, with selling expenses of 1,300. So what should we add here? Should we add the cost or the net realizable value? We have to find which one is smaller. So you need to find the cost, you need to find the net realizable value. Which one is smaller, you'll add. And to find the answer to this question. Okay, we're going to enter our answers through Kahoot. And we're going to give ourselves 2 minutes per question. if you finish one question early, then you should jump to the next question, right? So if you finish a question early, go to the next question. This is going to give us practice in doing questions on the exam under time pressure. Okay, the game pin is 9406. We have 9 questions. So this is matching the first question from our lesson here. Okay, so refer to question 1 here. If you finish question 1, then go to question 2. Start working on question 2. Okay, the answer is C, 2 and 3 only. Okay, so what are we at? Late. The question is, what should not be included? So labor cost, include, right? Transport cost to deliver goods to customer, not included. Now, cost to transport inventory in, we add. But cost to transport the inventory out to the customer, no. Administrative overhead. And administrative overhead, we leave out. The trick here is, earlier we said we add the overhead, right? We add production overhead. So production overhead we add, but admin overhead we leave out. Depreciation of a factory machine we include. So the best answer is C, 2 and 3 only. We not include. Okay, now we're going to question 2. So our champion now is TT, followed by V, followed by SF. Okay, good job. So most of you got that. The answer is C, 180. So the average cost before the first sale is 180 divided by 80. That gives us 2.25. And so we sell 40 at 2.25. And that equals 90. And then we buy 60 at 2.5. So 180 minus 90 plus 150 is 240. 240 divided by 100 is 2.4. And then we sell 25. 25 times 2.4 is 60. So minus 60. 240 minus 60 is 180. So that's the answer, C, 180. So we calculate, this is the continuous average cost. You need to find the average cost every time you sell. You sell 2 times, so you need to find the average cost 2 times. So this is the first sale. And then the 25 down here, this is the second sale. So in the continuous average cost, you find the average cost every time you sell. Okay, let's go to question 3. So number 1 is TT again. SM number 2. Very happy. Is that very happy? Number 3. Okay, question 3. Okay, good job. So D, 41. Let's look at the calculations. So the first inventory we buy 15 units of the $3 inventory, and then we buy $10 of the $3.5 inventory. First we sell 5. And it says sell at 3.3. 3.3 is the selling price. So that we call this is a distractor. This is to make you to log. We don't care about the selling price. The question is, what is the closing inventory? So the selling price is not important. We ignore the selling price. And then on 12 July, we sell, it says we sell 8. Okay, so again, we're going to sell the $3 inventory. So of the $3 inventory, we're left with 2. $3.50, we're left with 10. So 3 times $2, or $3 times 2 units is $6. 10 times 3.5 is 35. So 6 plus 35 equals 41. So the answer is D. Okay, next question. Okay, a lot of you chose A, and the answer is D. So most of you got the answer, but many chose A. Let's take a look here at the question. In times of rising prices, so that means prices are going up. The FIFO method of inventory valuation, when compared to the average cost method of inventory valuation, will usually give you. So prices are going up. Let's think about the value of inventory. So prices are going up, and in FIFO you sell the inventory from the beginning of the year.
Sell the cheap inventory.
So yes, we sell the cheap inventory, and then at the end of the year you have expensive inventory. You still have expensive inventory. So in FIFO, when prices are going up, in FIFO your ending inventory is going to be higher. So you have a higher closing inventory. So we know the answer must be C or D. And you remember the cost of goods formula is opening inventory plus purchases minus closing. So if you have a higher closing inventory, your cost of goods sold is going to be smaller. Remember, it's opening inventory plus purchases, and then minus closing inventory minus, and this is your cost of goods sold. So if the closing inventory is big, the cost of goods sold will be small. Cost of goods sold is small, your profit is big. So you have a higher profit. So some of you chose A, higher profit. That's right, higher profit, but it should be a higher closing inventory value. TT, what happened to you, TT? You're missing. Okay, SM. Where is SM? Who is SM? Okay, good job. And who's he, 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 he? Who's he, he, he? Okay, good job. And HK, who's HK? Okay, great job. So there are a lot of competitors, so to be in the top 3 is an excellent job. Okay, question 5. Okay, so we'll see if you got B. A few of you chose C and D. So the answer is B. Let's take a look. Okay, so for the first inventory, we see that the cost is $6. The NRV is 8. We take the lower. So 6 is lower than 8, so we take 6. 6 times 200 units is 1,200. For the second inventory here, super inventory, the cost is 9. The net realizable value is the selling price minus selling cost is 8. So what is smaller, 9 or 8? The NRV is smaller, so times 8. So that gives us 2,000. And then for the third inventory, the net realizable value is 10. 10 is smaller than 18, so we take 10. We take the smaller. That gives us 1,500. So 1,200 plus 2,000 plus 1,500 gives us 4,700. Okay, so now on to question 6. You got it? The answer is C. Let's look at the answer here. So we have 1,100 and 16,400. We add 1,100. Now for number 2, we need to find what is smaller. For number 2, the cost is 200 times 30. So that equals 6,000. And then the net realizable value is going to be the selling price. Selling price is 200 times 35. 7,000. So selling price is 7,000. We want to minus the cost to complete. In this case, 1,200. And minus the selling cost, 300. So minus 1,500. So that gives us 5,500. And 5,500 is the net realizable value. So we take which one is smaller? Cost is 6,000. Net realizable value is 5,500. So we take 5,500. And 5,500 plus 1,000 plus 116,400 gives us 122,500. Okay, now we're going to go to the bonus round. We have 3 more questions. Now the question is on the screen. Okay, good job. 2,950. So in the end, the last inventory that we had was the $50 inventory. How many units did we have? We had 50. And the $45 inventory, we had 10. So we had 10 left of 45, so that's 450. We had 50 left of the 50, 2,500. So that gives us 2,900 That was a bit stressful because it was quick, right? It's hard to read and answer it so quickly. So I think I should have given you more time to do that. Okay. Anyway, let's try it. Let's try the next one. Most of you got it, so great job. We've changed our rankings a little bit, so he. Now you're number 4, HK, now you're number 5. Number 2 now is B Sui. Who's that? Okay, great job. And one is LB Huit. Okay. Here we go. Question 8. Okay, good job. So most of you got it. The answer is B. So how do we get that answer? Well, first we buy 50 times $40. So that is 2,000. And then we buy 50 times 50. So that's 2,500. So the total is 4,500. So 4,500 divided by 100, the average cost is 45. We bought 50 and 50, and then we sold. How many did we sell? 60. So we were left with 40. So 40 is the closing inventory. So 45 times 40, 1,800. Okay, one more question. Last question. Okay, the answer is B. So in this question, this last question, the inventory, the closing inventory is 41,875. But in this case, it said, the question said including already the inventory. And this is a little bit tricky because it's the opposite of this question where it said excluding, right? So excluding, we had to add the inventory. But the question we just said says including already. So including already, we need to minus the write-down. We have to minus the write-down. So we compare cost. Cost is 1960 with the net realizable value. The net realizable value 1,200 minus the cost to fix 360. Is that right? I'm trying to remember the question.
Yeah, 840.
So 1,200 minus 360, 840. So what is smaller, cost or net realizable value? Net realizable value is much smaller. So we take 1960 minus 840. This is the one way you could do. You minus 1960, and then you add 840 like that. And that gives you the answer, 4755. The other way you could do it is you could get the write-down expense. The write-down expense is, the write-down expense is 1960 minus 840, which is 1120. And then we continue to take 41,875 minus the write-down. So we just subtract the write-down. And that also gives us the same answer. So we can minus the wrongly priced inventory, then add back the correct price. Or we can take the total inventory and then minus the write-down expense. So 41 is the total inventory. Okay, let's see who our champions are. Okay, Bisoy, where are you, Bisoy, again? Okay, great job. You came back from behind. So you were behind a while and you came back for to win it, so congratulations. SM, where are you, SM again? Okay, great job. And in fourth place, VL. VL, where are you, VL? Okay, great job. And where are you again? Okay, excellent job. question is on PPE. PPE is an asset, so inventory is an asset. Is inventory current or non-current? Inventory is a current asset. PPE is non-current. What is the difference between PPE and inventory? Inventory are assets that you're going to sell or use up. So inventory are assets you're going to sell or use up. PPE are assets that you're going to use. You're going to keep and use. So Barai Bingwood, they have the inventory of houses that they sell, but they also have some buildings that they use for their office. So the office building for Barai Bingwood, that is their PPE. They're going to keep it and use it. PPE, we probably have a definition here early, not yet. So I'll go ahead and define it now. Property, plant, and equipment are tangible assets. So we have to be able to touch them. So tangible means in Khmer Rupai. So you can touch it. Tangible assets that you're going to use, that you're going to be keeping and using, not selling. For more than one period, for more than a year. So it's a non-current asset. In accounting, the word property means land and building. I see often that companies translate into Khmer property as Throps and Bot or something like that. But in English, property, in accounting, property means land and building. So if you call it Throps and Bot or Thurop when you translate it into Khmer, okay, that's fine. But remember the meaning. The meaning of property is land and building. And then equipment, everyone knows equipment. And then plant. Plant is just a kind of equipment, but typically plant we refer to equipment that doesn't have moving parts. And equipment that's fixed in one place, like angtak. So angtak doesn't have moving parts, it's fixed in one place, so that would be regarded as a kind of plant. Does it matter, the meaning of plant versus equipment? No. So we're not going to classify our PPE as a plant and then some as equipment. It's not necessary. What is some PPE of your company? What PPE do you have in your company? Building. What other things? Computers. Okay, computers. Can you touch a computer? Yes. So tangible. Are you going to use a computer for more than a year? Yes. So, okay, PPE, yeah, computers, building. Yes, in case we just look around the school, okay, we see the projector. We have the Ganchak. We have furniture. Yes. So a lot of electronic equipment, lights, cameras, routers, servers, delivery vehicles, trucks, vehicles, machines. I'd like to just briefly review the word capital and revenue expenditure. These words are not in IFRS. These are non-IFRS words. But they might be on your exam. So it might be on the ACCA exam. And capital expenditure, on the ACCA exam, capital expenditure means that you're buying a non-current asset. Revenue expenditure means that you are spending money on your day-to-day operations or you're buying a current asset. So spend money for rent, spend money for electricity, spend money for staff wages is revenue expenditure. Spend money to buy a building, spend money to buy a machine is capital expenditure. And then capital income is long-term investment. So money from the shareholders' investment, money from bank loan, capital income. Also money from disposal of PPE. Revenue income is money from sales, money from your customers is revenue income. And I think what I said, money from loan, money from shareholder, would be better to say capital receipts, but capital income is better for disposal of assets. The main ones on your exam are capital expenditure. You just need to know what that means. So capital expenditure means when you spend money to buy a non-current asset. Okay, I've given you the definition of PPE, and the definition I gave you is here. The standard for PPE is IAS 16. The standard for inventory was IAS number 2. For your exam, you don't need to remember the standard numbers. It's okay. If you remember the standard number, okay, great. But if you don't remember the standard number, it's not going to affect your exam. So standard IAS 16, property, plant, and equipment, gives us the definition of PPE, tells us how to do accounting for PPE. So it says here, property, plant, and equipment are tangible assets you can touch, held by an enterprise for more than one accounting period, so non-current, for use in the production or supply of goods or services, for rental to others, or for administrative purposes. So if you have an airplane and you rent the airplane to someone else, that is PPE. If you have a machine plug and you rent to someone else, that is your PPE. If you have a bus you rent to someone, that's PPE. There's an exception here though. Except land and building. Because land and building that you rent to other people, land and building rented to others,